designing a bad financial statement because these numbers, even though they're the same, they're not really connected directly. Okay, they just happen to be the same. So this here, minus 5,000, is being transferred to here. So since you're taking it out of this bucket, it's negative. And then you're putting it in another bucket, it's positive. And then it just so happens when you take the revenue.
So you're just showing the difference when you get ready to use it, you move it over.
Yeah, okay. That's right. Yeah. And I'm sorry that these numbers just happen to be the same.
Okay.
So it's a little confusing.
Right.
Sorry about
Thank
that. So there any questions about this? So the big point is that each internal accounting software is going to do this a little differently. And the important thing is to know what it's doing and making sure that you can get a clear idea of what your surplus or deficit is on an unrestricted basis. For the revenue that you had available to spend this year and your expenses that you spent this year, what's the kind of net difference? Kind of questions or? All right, so we're almost at break time. One more thing to cover, and that's the nonprofit balance sheet. So what are some assets that a nonprofit can have? Cash, receivables. Building and oh, she's cheating. You're reading. Okay. Now you guys might have a long hand.
I'm a good student. Why can't I do that?
There you go. Reading ahead, you're prepared. So there are some great examples. So cash, receivables, building. You can also own investments. A lot of the things that a person individually can own, so can a nonprofit. A loan. A nonprofit can own a loan if they're a lender, right? So if you lend, if I'm a...
Like how you get a loan and you have infusion of money.
Yes.
Where would that fall at on the balance sheet?
Yeah, that's a great question. It's going to show up in two places, right? When you get a loan, two things happen. You get cash, right? So your cash is going to go up, but your liability is going to go up. So at the end of the day, what happens to your net worth?
It balances
stays the same, right?
Right.
But I have to be,
Plus and minus.
it has to always be appear on one side as well.
Yeah, yeah. Does everyone here know what receivables are? Okay, just in case someone's embarrassed and say they don't know. Account receivable. So a receivables actually can be several different things. Sometimes it's called accounts receivable, grants receivable, pledges receivable, contract receivable. And basically it means that someone else owes you money, right? If you have a grant receivable, it means a foundation promised to give you a grant sometime in the future, and it hasn't given you the cash yet, right? But they've given you the letter to say they've confirmed that they're going to give you this. It could also be, trying to think of a situation.
Could it be also where you had a fundraiser and people promised
Yes.
to give you money, and what you do is you take and, I'm sorry, let me just say, I used to work for Big Brothers Big Sisters.
Oh, okay.
So when you were talking about restricted funds, the Amachi program was a restricted fund. The government gave Big Brother Big Sister a pot of money that they could only use on mentoring children of prisoners. We also did a breakfast where we had people come out, fill out a pledge card, and say they owed us this amount of money. So that would be a receivable, is the pledge that was made.
That's great, yeah. Or you think about like a health clinic, right? So usually they will, when a patient comes, they might collect the copay, but then they're going to bill the insurance company. Or sometimes if the insurance, sometimes you still get a bill later on, right? So the medical clinic is going to have on their balance sheet, say patient receivable, insurance company receivable, right? Okay. And then liabilities, I'm just going to flip this side since you're all cheating anyways. you have payables. So these might be called accounts payable. Sometimes you'll see something called accrued expenses. So on a balance sheet, you'll show what other people owe you. It also shows what you owe other people. So payables are bills outstanding. So you've received the electric bill, it's for last month, and you haven't paid it yet, right? And that's not always a bad thing. Most nonprofit financial statements have payables, right? Because there's a lag between when you use electricity to when you actually get the bill. And usually salary is like, there's sometimes a 2-week lag before salaries get paid out. So it's normal to have payables. There's also sometimes something called deferred revenue. Does anyone here know what deferred revenue is?
It's where
would assume it's income that's
Is that where
pending.
you did a job already and somebody owes you money?
That's
It's money that.
that would be a receivable.
It's
Someone
money that
owes
the
you. This is
organization gotta
something
pay
you
out.
owing someone else something.
You're gonna pay them at some point in time later.
Not quite.
No?
So, because if you borrow money directly from someone, that's probably, it's either going to be like personal loan, or it's going to be
Oh,
like a.
is that like a dividend or?
Not quite. It's basically when an organization sometimes collects cash in advance of providing a service. So sometimes maybe you might collect tuition for a school at the beginning of the year, right? But you still owe those customers a service.
Okay.
And so it gets recorded as deferred revenue. So what happens is that you're going to get the cash. So here it's $5,000, right? But then at the same time, you have a $5,000 liability, because if you don't provide that service, you owe that money back to the people, right? So, so common example is paying tuition in advance, right? So if a school might collect a whole semester's worth of tuition at the beginning of the year, but if they can't provide classes for the later half of the year, it has to pay that money back. Or sometimes magazine subscriptions and ticket subscriptions, right? So you pay for a year of magazine subscription in advance, or you pay for tickets for different theater shows a year in advance, right? The theater company or the magazine company has deferred revenue because they collected money from the customers, but they have to make sure they can put on that show and provide that magazine, otherwise it has to pay all that money back. Does that make sense?
But also, when you go to college or university, and you have to pay that year's meal plan, is that deferred revenue?
Yeah. That's for the university, right?
Yeah, for the university, yes.
That actually made me think. There's another asset I forgot to put down here, and that's called prepaid expenses.
Oh, yeah.
And that's when you pay in advance for the year, right? So maybe you pay insurance in advance of the year. So it's something you paid out in cash, but you also get credit for it, right? And if something happens, like if the insurance company can't provide the insurance anymore, they're supposed to pay you back for that. The funny thing is sometimes an asset for one organization is a liability for another, right? Because everything's connected. So that made me think of that when you, say you prepay a meal plan for a whole year, as the payer, that's kind of like a prepaid expense for you, right? You already paid for food for the year, but for the university, it's deferred revenue because they have to make sure they can provide the food. Is that okay? Or I'm just getting too excited about that.
You don't get your money back if you don't use it. Right.
Other questions?
Yes, so they don't give you, at the end of the school year, if your child particularly doesn't use that money, they don't get it back.
Well, but if I guess if the school had the cafeteria open that whole time, you know, they just.
Right now.
Yes, I know, it's unfortunate.
They will, sometimes they'll carry it over, or some people say you have to use it if you
You
don't
can
use
use it or
it.
you lose it.
Yeah.
So you don't get your money back.
Right.
Like,
That's,
it's
I
like
think
spending the
that would be
That should be a
No,
deferred
that's
revenue.
the, get your money back.
Yes.
that prevents them from offering the service, then they have to pay
Yes,
it back.
that's a great one. Did you catch that?
I know, but having two kids in college, you know, you don't get the money back. I'm just
I think they put in legal language
just
that
putting-
keeps them
I'm just
from
being-
doing it.
I know.
Yeah.
I'm just being-
Yes.
I read this spreadsheet once that had some amount of cash that the government had from prepaid insurance when people sell their homes, and they already had prepaid insurance
Okay.
that was left over that never was collected.
Huh.
And it was in,
Wow.
so is that similar to what you're speaking about? Yeah.
It's possible, like if somebody, you know, personally, like my house has an escrow account to it. My husband and I have a house, and I guess our insurance company makes us prepay our insurance. And so for us personally, we have prepaid insurance, but I'm not sure what would happen if we sold the house or if it got foreclosed. What would happen to those funds? I don't know if that's what you're getting to. Yeah, hope you get it, but I know the bank may take it. I don't know the details.
No, it's the next person has to pay for the insurance.
Okay. So let me see if there's anything else. Okay, so assets, what you own, liabilities, what you owe, and then there's also the net asset section, right? The net worth section. I also kind of think about as the home equity section, right? Because if you take the value of your house less your mortgage, then you get your home equity. and hopefully it's positive, but for many people it hasn't been positive. Nonprofits have another element to that, and once again you'll see the restrictions show up, right? Unrestricted, temporarily restricted, permanently restricted. And that's because a nonprofit can have, I guess in this case, $100,000 in the bank, right? And $100,000 cash sitting there. It may have no loans, no payables, no deferred revenue, no liabilities whatsoever. But it may not be fine and happy because it has all this money in the bank, because that $95,000 may have restrictions around it. So maybe it's restricted for pencils for their after-school program, right? So their net worth, they may have like a high net worth, but because it has restrictions on it, it may not be that, they may not feel that secure, that happy with that amount of money. So just be careful that when you look at the net assets of a nonprofit, look at the restrictions breakdown, right? Because you could take that 95,000 example and say maybe this organization has $0 in that unrestricted bucket, but 95,000 permanently restricted that it can't touch, right? So that organization is probably in financial crisis, even though it has a huge net worth, simply because of donor restrictions. Any questions? So I think the big takeaway is whenever you look at nonprofit financial statements, always pay attention to how restrictions are represented. I'm going to show what the balance sheet looks like on an internal financial, like an internal balance sheet from QuickBooks. And this is just a quick example. So for the assets, if it's internal, there might be more details. So sometimes they'll list like what checkings account it's in. The receivables might have a breakdown in major categories. And then the same thing with liabilities. In an internal financial statement, you might have more detail. And then a lot of times for the QuickBooks software, especially if you're using that, they may only just have a retained earnings category. So all the net worth might be lumped in one bucket. Sometimes I think QuickBooks actually lets you create different funds so you can track things differently, but it all depends on your software. But a lot of times they'll use the for-profit terminology, retained earnings, instead of net assets. So quick trick, if you're ever confused between all these terms, Google is really good for typing these things in, because there's actually a whole bunch of like online investor dictionaries. So a lot of times when you find a financial term you don't understand, you can just enter into Google. You usually can get a pretty reliable definition. Because sometimes we're going through so many terms, it's not easy to remember all of them. But it's good to kind of spend some time with your internal financial statements to see how it's tracking all of these things and how it works. And it can be different for every organization. So any questions about this?
Yes.
Yes. Okay. Yes, please do.
That's funny. In my head right now, the term liquidity is keep coming up, right? So with I'm just thinking about an endowment.
Okay.
That's really, it's almost like a non-liquid asset
Yeah.
of a non-profit for the most part, because you can use probably some of it, like you said, but the bulk of it, because while you're going over all this, I'm saying like, wow, we're looking at like really like the liquidity of a non-profit. And then, I really didn't know about the restricted assets and all of that, right? You can have it there, but boy, if you add it there to represent something, it can really like take your organization under, because you don't have that money to put out like that.
Yeah, that's a great point. And I'm glad you raised the term liquidity. For those of you who don't know, liquidity means your access to cash, right? And it's really important, because if you don't have liquidity, like, you're not going to be able to operate. And to kind of get to your point, this is also from NFF, but they actually do this little kind of like a map, and one axis they call like the liquidity axis, axis, and then the other one they'll call kind of the restriction axis. I can't seem to talk. Restrictions, right? So over in this corner they'll have unrestricted, and in the middle they'll be temporarily restricted, and here is permanently. So the further you go out, the more restrictions, right? And then along this axis down here, there'll be things like cash, move a little bit up. Receivables, so hopefully they'll become cash soon. And then up here you'll have like building, right? So you can actually take what your organization owns and kind of map it out, right? So You could have an organization that maybe has an unrestricted building, right? Maybe some receivables, so that's good. And maybe they have a lot of cash, but like you're saying, what if it's all permanently restricted? So if you were to only look along this column, you're like, oh, they're doing okay. They have all this cash. But once you factor in the restrictions, they may not. And in the end of the day, you're going to want more stuff in this corner, less restrictions, you know, more close to cash than anything else. And that's.
So what's the benefit of having the permanent restriction?
That's a good question. Well, for someone, does anyone have some comments to make on that?
Just in terms of
permanent restriction.
But what's the benefit of having a permanent restriction?
It can fund ongoing programs. Yeah. You can potentially know that there's going to be a certain amount of money, depending on how large the fund is. You can, if you, on average, if you know that, say you get a 10% return on your investment from the endowment, say it's 50, say you have $500,000, and you know you potentially, it produces 10%. So you know at least every year you can basically, and it's just a projection, but it's $50,000 that you can count on estimating what you're going to put into your budget next year. And you might be able to take the $50,000, correct me if I make correct, and move it over into the unrestricted fund, because that's something that is for the perpetuation of the organization. Watch out for that.
That's great. Does anyone have any other comments on it?
I was going to say too that in relation to what he's saying is that if you're a school, private school has an endowment of say $100,000 for teacher, it helps with professional development and other things. So it's ongoing capacity building of your staffs, and also it gives you more, helps be more sustainable over time.
Yeah. Well, I'm going to say you're all right, but I also want to qualify it, right? So endowments can be useful because you do get that investment return. So Samuel Fletcher Art Memorial, I think 20% of the annual revenue comes from the fact that they have a huge endowment. But the challenge is that if you're in crisis, you can never rely on that money. You're not always sure what the market's going to do. And sometimes it takes a lot of endowment before you're able to get even a little bit about money. And I think the risk is sometimes organizations think, if I have an endowment, I can be sustainable. So they go out and spend all this effort trying to raise an endowment, and they don't get that much money in the end of the day. And they hurt their existing programs because they're putting all this effort raising money that they can touch only a very small portion of. So there's actually something called, that some nonprofits are raising now, called board-designated funds. And it's actually an alternative to endowments. So board-designated funds have board restrictions on them. So the board designates a fund for a specific purpose. And a lot of times people are willing to donate to that because there's some protection around the money, right? But if the board needs to be flexible about it, or if a nonprofit needs to access that money, the board can change how it designates it.
Can an endowment be nonprofit?
Not if they were the one that set it up.
No, I'm talking about, let's say somebody gave a nonprofit like $50 million,
Yeah.
just to help them as a good nonprofit. So they saying there's a permanent endowment, and let's say the nonprofit kind of not did nothing illegal, but they wasn't managing whatever they was making off the endowment. So the people that gave them the endowment said, we want to revoke that and take our money back. Is that?
I think it's possible, yeah. If the nonprofit violates donor restrictions, it's probably going to go to court.
I ain't saying they violate, I'm just saying they look at it and say, I don't think y'all know how to manage money and so forth and so on. And we don't want that to be lost if the nonprofit happened to go bankrupt or something.
I actually don't know if that's the case. I mean, if the nonprofit is still fulfilling all its, so the nonprofit technically owns that money, right? It's donor restricted, but the nonprofit owns it. So I think unless the donor can demonstrate that the nonprofit's been using it for other things or violating the restrictions, they really can't do anything. So, I mean, if
they got
the
a tax break off of that too.
Yeah.
So they have to pay that back.
yes, and if the donor really wanted more control over it, they would probably set it up as a separate trust, and then every year kind of give. So they would. There are ways to do that, but once a donor permanently transfers the funds to the nonprofit, unless there's a restriction violation, it's
I mean,
limited.
a great example of that is the whole fiasco with the Barnes Foundation.
Oh, yeah,
And
yeah.
it was very restricted.
Yeah.
Yeah.
And the city and everybody else had to take them to court, and it was in court for years before it got overturned. So, you know, even though it's restricted, you know, it's really tough to change it.
So I'm just going to move us forward.
I just had one more question, because when you went to the, let's say the left side of the axis, you made me think about something in business, about depreciation of like your buildings and stuff like that. Since nonprofits really don't pay taxes, do they write depreciation off?
Yes, and
Because it fits in here, right?
yeah, and I actually did not talk about it, because just in terms of time, I can spend 10 seconds on depreciation. Basically, in your audit and sometimes in your internal financial statements, there'll be an expense that shows up that's called depreciation. And the basic idea is it's kind of writing down your building and your car, because every year there's wear and tear. And it's an accounting approximation of that. So I just have one more slide to cover and then we'll have a break. I'm sorry to kind of move things along, but there's a second half to today and I want to make sure we have time to get to it. But feel free to chat with me during the break if you have questions. So I just wanted to cover that there's actually two main types of accounting methods. There's cash accounting and accrual accounting. Accrual accounting is more complicated, and all the financial statements we just went through are actually accrual accounting financial statements. So we just did the harder thing first. But let me explain what the difference are. So cash and accrual accounting are basically two different ways to recognize financial transactions. And the best way for me to do this is just to give an example. So imagine that you're running a daycare center with subsidized payments from the government. So when a child comes, they might pay us, the mother might pay, or the father might pay a small fee, and then the daycare is going to turn around and bill the government, and then the payment for the actual service might come a month later. So under cash-based accounting, this daycare center is not going to recognize revenue until it gets that cash payment from the government, right? So that's how cash accounting works. It's cash in, cash out. Whenever you write the check, whenever you deposit the check, that's when you recognize transactions. And a lot of times, small organizations use that because it's, you know, it's easier to track, it's easier to implement. Under accrual accounting, if we take this daycare center, the daycare center would recognize the revenue that it's supposed to get from the government. During the week, it provides services to that child, right, when it cares for that child. And then what's going to show up on its balance sheet?
It's not going to show up in the cash account because it wasn't cash, but it's going to show up on that part of the asset, asset account.
A receivable. It's going to be a government receivable, right? But on the income statement, it would have revenue for that, right? So, you know, I don't know how much it costs a lot of money to, like $500 revenue, right, for taking care of that child. But then there's only going to be a receivable associated with that. And the whole idea is that in accrual accounting, you're trying to match revenue and expenses to when the service delivery happens. Whenever you deliver the product or deliver the service, you try and match it as closely as possible. And the helpful thing about that is that you know how well you cover your costs, because everything's matched together. And this is pretty much what's used in larger organizations, more established ones. It's what the auditor does when they checks your books, and it complies with GAAP standards, which are basically the auditor standards. And so, I guess, you know, if you're starting off and you have a $50,000 budget, you may just be doing cash accounting. But eventually, if you do become larger, you're going to have to move to accrual. And everything we've been looking at today is accrual. Because if you're looking at cash-based financial statements, you just see cash in, cash out. There wouldn't be all these receivables and things. But you also have to be careful, because both of these can be a little bit misleading. So if you think about the daycare center again, let's say you're trying to do a 1-month income statement. So if you're doing cash-based, let's say you haven't received the cash yet because the government hasn't paid, but you've written out lots of checks for salaries, utilities, and all the costs it takes to provide. So for this month, you're going to have a huge deficit, right? Because you have no revenue, but lots of expenses. But that's kind of misleading, right? Because you're going to get payments later. At the same time, the accrual can be a little bit misleading as well,